Hello everyone, welcome to the Kyber interview. I'm Thomas Hu, founder and CEO of Kyber Capital. Today we're very happy to have Jeffrey Young, founder and CEO of DeepMacro, a global investment firm focusing on machine learning and big data for the global investors, back here with us. Hello Jeff.
Hi Thomas.
So we understand that recently you're on a Asia trip, meeting with central bankers and institutional investors, former policymakers, hedge fund managers, and many of whom are your clients or your partners
Correct.
in Beijing and Tokyo. So curious to know what's on their mind, what drives their awake at night these days?
Well, there's a long list, but if I would summarize, I'd say the first is the state of the Chinese economy. It's pretty much a universal view that China's very weak, and that's number one. I would say the second is markets themselves. They've been volatile, and pretty much every strategy that investors have tried has struggled so far this year. The trade war between China and the US is also really top of mind, both in China and I think more broadly throughout the region, because at least some people feel that part of the reason why the Chinese economy is very weak is because of this trade spat. We have a little bit of a different view, but certainly that's a view that I think is pretty common throughout the region. And I'd say a fourth is the concern about the business model of big tech in US. The likes of Facebook are under a lot of criticism for especially their data sharing arrangements and more broadly the business model. And because tech has driven a lot of the US equity market, because tech drives a lot of real economic activity in Asia, that's been a big concern too.
It sounds like there are many layers of problems and concerns are being discussed in this kind of a setting. So maybe we can just break it down a little bit. Mm-hmm. So starting from the central bankers, and we understand that obviously trade wars and in this kind of a rates rising environment creating a lot of uncertainties, and especially the Chinese economy is being weak, but also it can be argued that it is the Americans' actions or a lot of the structural reasons that precipitate this weakening of the Chinese economy, or that certain folks are trying to intentionally weaken Chinese economy by using geopolitical measures.
Sure.
Do you find that view a consensus among central bankers, and are they going to propose any countermeasures?
I think there's certainly concern about the trade war, but the impact that the central bankers see from trade is really from traditional channels. How much is demand going to weaken, and can monetary or fiscal policies provide an offset to that? The reason why they couldn't earlier in the year is, of course, because the Fed was raising rates, and in fact is continuing to raise rates as they just did this week. I think it's a combination of a trade war or skirmish that will hurt growth at a time when the central bankers are actually going the other way. They're not in a growth supporting mode, they're more in a withdrawal of stimulus mode. Now, of course, that appears to be changing on the margin. The Fed has dampened its rhetoric. We've picked that up in our own big data measures of the central bank itself, and it seems to be reflected in the market as well. So I think that the concern with trade really is that up until now at least, it's a negative factor that nobody's really equipped to offset.
So what does DeepMacro actually see from a data perspective? Did your model pick up a lot of those signals before any of those patterns became perceived by the market?
Yeah, if we start with rates and then maybe go to China, we did predict or pick up a peaking of US short-term interest rates from about the midsummer. June, July was when our model was looking at two-year interest rates at about 3%, 3.31, and really getting very toppy at that point. It wasn't very much long after that that in fact we thought rates would actually go down on a 3-month horizon, and that's kind of what we're seeing right now. So that was a pretty early call. And it's not that we were expecting a recession or a disaster. It's just that growth had clearly peaked in our view. Inflation in the US had come off the boil, and risk appetites more broadly were getting a little weaker. And we were seeing market risk rise. And so those combined into a situation where the Fed would not have to hike as much as the market was expecting. So that was kind of one early pickup. On China, our current view is that, and this is going to sound a little bit different, but our current view is that the market pessimism about China is a bit overdone.
Okay.
And why do we say this? Well, we do have several alternative data sources that are not government and that correlate with some part of the Chinese economy. One of our best ones is data on air pollution over rather small areas of China and actually the whole world, but let's focus on China. It basically makes a 20 square kilometer grid. And so obviously there's many of these, and just measures the different industrial pollutants in the atmosphere over that grid. And we can then use that to back out what's happening on the ground, because most pollution is caused by burning coal, making electricity, driving trucks and things like that are correlated with economic activity. So on that side, certainly it's not strong, but it's definitely stronger than the last couple months. And it's certainly stronger than where I think sentiment is. So I'd say on the industrial side, things are looking possibly better. The other really critical difference between now and when China's been weak in the past is inflation. Back then, China was in deflation. Right now, China has positive inflation. And so that whole debt servicing problem, bank issues, capital outflow, dramatic weakening of the RMB, we're not seeing that really negative cycle kick in. And so those are the two that we're picking up on China. We're far from, we're not bullish, but the way that we'd call it is cautiously optimistic that the market's too negative.
And so it can be said that right now what the policymakers are doing in China, despite all these geopolitical noises, are trying to manage a decline or deleveraging situation orderly. And and this sort of behaviors are being verified by your model.
Correct. That's exactly right, that there's been a fairly orderly deleveraging. I'm in New York, and a lot of our clients are in New York and London, and there's always a really underlying tone of disbelief that it can be done.
Why is that?
Because deleveraging is a messy process, and because hedge funds like big moves in markets, not orderly processes, to be honest. Except when they get too big, like this month, and then they don't like it. But I think that the reason why China has been able to do it so far is that it still basically has capital controls that are relatively effective. Not perfect, it's not like the country is walled off, but they have learned the lesson from the 2016 episode, from the early 2017 episode of large-scale capital outflows, that you don't want to let that get out of hand. And as long as the capital stays in the country, you can achieve this orderly deleveraging. It drives the hedge funds crazy because it means that they can't short the RMB. But that's not very high in the list of things that Chinese policymakers are trying to do.
So this is supposed to give the benefit of the doubt to the Beijing government and say they could manage this deleveraging orderly, but can they manage a decoupling from the U.S. economy or the world economy orderly? Because it seems like that there is now an anti-China or anti-Chinese communist coalition being formed, at least from a commercial and geopolitical perspective, globally, right? So is your model or any other symptoms that you have already picked up and say, this is going to ultimately reverse back to the European and most important American economy?
Well, certainly I don't think. I mean, my answer to that is no. I think that if indeed what we're seeing is the forced, let's say, reorganization of supply chains, which, that's actually, I think, a strong driver of the hawkish view in the U.S. toward China. The Vice President Pence has been the the clearest exponent of that view. And a lot of it's not so much, there are market access issues obviously, but a lot of it is that the supply chain is believed to be A, compromised, and B, too dependent on China. Now, if we allow politics to determine the supply chain, rather than where it's makes rational economic sense to locate different parts of the production process, I think everybody is worse off. And I think that ultimately that is a constraint on how far the U.S. pushes this. I think that, as you mentioned, there are some voices in the U.S. that do want to weaken China. And they've said it, so I don't think I'm really saying anything that's not out in the public. But the problem with that is, indeed, if we are in a globally connected economy, that will hurt the U.S. too. It could be through the stock market, which we're kind of seeing right now. It could be through consumer prices going up. It could be through employment effects because Chinese are not investing as much in the U.S. But it's some combination of all of these. And I think that that is also going to constrain the U.S. administration about how tough of a stance they can ultimately take. We'll see what happens in this 90-day window that the two sides have. My guess is there will be some kind of deal that will involve some concessions on each side because the maximum position on each side is negative for both.
If this turned out to be a war of attrition or a marathon to the best, that both sides will need to tough it out and see which one has the longest breath, right? Do you feel the U.S. economy right now is in a decent shape or a stronger shape to take on this challenge without giving too much?
I mean, currently, growth is good. Unemployment rate is very, very low. Inflation is moderate. It's not so low, but it's moderate. The Fed has raised rates a decent amount. They could cut. I don't think that there's much room on the fiscal side, although certainly the government has talked about it, both the Republicans and Democrats before the election were talking about tax cuts. So you're starting off from a position that's not too bad, and you have a few arrows in the quiver if things worsen. And I think that that is, again, part of the, let's say, the hawkish, the fairly hardline negotiating posture, that if we can get this done in 90 days, it's going to be over before the U.S. economy materially weakens, and we have a few things in our pocket just in case it does. On the Chinese side, the sentiment is very weak, but we don't really see a lot of signs of stress. The equity market is obviously very weak, but it's not like there's that much activity that's linked to the equity market. I think macro and the stock market are kind of delinked in China. The credit issue seems to be, again, the deleveraging is being controlled. We don't see any real signs of a weakening of the labor market that would create political pressure. So I don't know. A war of attrition, if it's really, really long, would definitely hurt both sides. I think that's one of the reasons why they sort of agreed, let's try to get this done in the next few months.
Yeah, because the political process, especially the internal dynamics of the internal politics at both countries, are definitely driving a lot of the discussions.
Sure.
From a strategic perspective and also from ultimately the commercial perspective. Yeah. I understand that you guys did a lot of work on the U.S. midterm elections.
Yes.
Right? Can you give us a little bit sense about how did it go? I mean, from a model perspective?
First, the modeling itself. One of the things we look at is social media. We look at which candidates and which parties are getting more support, more intensity of support, which are doing a better job of influencing undecided voters. For that, actually, social media is a really rich source because political parties themselves have sort of declined, and labor unions, these sort of the institutions that used to organize our politics are much weaker. In the old days, if you were a union member, you voted Democrat. If you're a country club member, you voted Republican. Now, it seems like more union members vote Republican and more country club members vote Democratic. So it's all been rearranged. But in that void steps social media. And across the world, politicians and political parties have learned that social media is a tool of influence. Trying to get out the vote, trying to get people to influence their neighbors, their coworkers, their family to vote their way. So we look at social media. We were early on in the election, we thought that there was a chance of a blue wave. In other words, that Democrats would take both the House and the Senate. And then the Kavanaugh hearings came. And curiously, as a result of that, we did see a fairly distinct swing toward the Republicans in a lot of the close districts.
Okay, what drove that?
If we look, I do think that the Kavanaugh hearings were sort of a driver and a polarizer.
Me Too and female issues
Exactly. Are much, they're generally speaking negative for the Republicans, or definitely negative for Trump. Of all the issues that we track in this 350 million tweet data set that we have that mentions Trump in some way, the one issue that has shown a consistent attention is basically the Me Too women's harassment issues. Russia, few people care. Even the tariffs, there was some interesting back and forth about it early in the year when they were first announced, but it didn't seem to be an election issue. I think that what the hearings did was they basically galvanized both sides. They sort of got each side's activists sort of more engaged. But at that point, the Republicans really got engaged more. And so we kind of detected a swing back toward the Republicans, so that at least they would keep the Senate. The ultimate results were, as we know, the Democrats picked up a lot in the House, but the Republicans picked up a few in the Senate. So I wouldn't qualify that as a blue wave. I would definitely call it a pretty good day for the Democrats, but a certain reading would say that they didn't do as well as they probably should have, given how unpopular Trump is, and et cetera. So I was actually pretty pleased with the results of the analysis in the U.S. And in some other countries as well.
But it seems to be, if we recall the market reaction after the midterm election, that the market seems to take cues that President Trump got weakened, and therefore it may be good for the market because we're going to go back to a more pacifying, if not or a relatively peaceful environment for business. But now the market seems to be again on the liquidation mode, and then President Trump is making all those noises again with those geopolitical concerns and trade wars. How influential is President Trump to the market perception based on your data?
Hard to say. I mean, I think that part of the market reaction since the election is the sense that the Democrat-controlled House is going to be more focused on subpoenas and investigations, kind of turning the tables on what the Republicans did at the late years of Obama, than it is on the issues that business is concerned about: immigration reform, deregulation, possibly further tax reform. The structural issues that could raise U.S. competitiveness. I think that that's got to be part of it. I also think that it's not only the investigative sort of mood about Trump, but if we're talking about the market, I don't think we should underestimate the impact on the tech sector that we started by talking about. Tech has been a big driver of the market gains in the last, in this bull market. And there's very little scrutiny of the underlying business model until recently, and now it's all over the place. It also seems to be fairly bipartisan. There are a lot of Republicans who also feel that they've gotten too big, they're too powerful, intentionally or unintentionally they've strayed into politics, and there's any number of reasons why a politician on either side might want to try to clip their wings. And this is, I think, pretty damaging for their overall business model. Yeah,
if you look at the overall environment, right, in a low yield, low growth environment where technology sectors is the only group of companies that can generate any growth, and just look at their valuation multiple, clearly is carrying a lot of hypes and hopes from the investor. And now it seems to be in liquidation mode. People may be thinking that there are monopolies or monopolies in the making, or already too big to bail, or too big to fail, or even too big to jail in certain regards. But that kind of a sentiment, can it be reversed if, in the worst case scenario, that the Fed would cut interest rates sometime in 2019? Will we see a restart of this whole market dynamics?
I mean, whether that happens to, say, the big tech or not, I think tech in general, which you're asking about, I would say yes. I mean, I'm still very confident about the ability of tech to innovate. It really is the driver of modern global economy. And I don't think that what we're seeing right now makes a whole lot of difference to tech entrepreneurs. they have to get up and innovate no matter what the environment. And so at that level, I think we just see another wave, a continuing wave of innovation, and that's a very global process as well. I mean, we're seeing tech centers pop up all over the place. A low rate environment would simply mean that more capital goes there than it does into alternatives. I mean, people are talking about, in the US at least, cash is a legitimate asset class now because rates have risen enough so that people might just kind of park money there. If the Fed reverses, then we'll be back into the investment environment that we were in the last few years.
So how do we think about this from your deep macro construct of growth, sentiment, and inflation, right?
Mm-hmm.
In a rates decreasing scenario, if that happens, how should we act? And do we have a portfolio construction recommendation or some kind of a strategy?
Right.
How should we do in this environment?
If I were to just summarize it right now, I mean, in the short run, we're still in a sort of very cautious liquidation mode, as you mentioned.
Okay.
I think our strongest sort of position right now is to be long the US dollar in the currency world. The US is still, to some degree, people say the cleanest dirty shirt. I wouldn't say that it's dirty because global growth is quite good, but it still is at a relatively firm position in its cycle. And interest rates are fairly supportive of the dollar versus some of the low yielders. So I would say that the dollar is still probably where you want to be. When we get these bouts of market turmoil, it also tends to attract capital too. So I think that there are some pretty good reasons to be long dollar. Let's say kind of big asset allocation decisions, say between equity and fixed income, I would be underweight equity, I mean, for now. And the models are definitely underweight sort of neutral market cap benchmarks, but not in, not hiding in a hole underweight. We still feel that there's some legs in the global cycle. And when we look at risk, I mean, the equity markets had a really horrible month and a pretty bad quarter, and it's looking to be a pretty bad year. But a lot of the pain has been located in equities. If you really want to leap into a systemic crisis that says you don't want to own any equity and you want to only be in fixed income, you need to have leveraged institutions that are taking hits. And knock on wood, we don't see the source of leverage buildup that we saw before the Great Financial Crisis, or before any of these sort of major crises where the equity market went into multi-year bear markets.
But aren't you not concerned about the leverage loan market or a lot of those high-yield bond markets or loan market in the United States? Because we talk about shadow banking problems in China all the time, but we rarely talk about the shadow banking problems in the United States or in European countries. Does your model suggest that those risks are manageable, or because the banking sector already rebuilt their balance sheet so that they can absorb the risk?
Exactly. I mean, they seem to be held mostly by hedge funds and other entities that are basically equipped to hold that. If a hedge fund loses 10%, it's really not the end of the world. They're not leveraged into the rest of the financial system. It's not like we have the repo market financing the degrees of leverage and the multiplication of leverage that we did before the crisis. So there certainly are individual products that have some leverage in it, but even hedge funds, they just aren't leveraged like they used to be. It's been extremely difficult to get that kind of financing balance sheet from banks or even non-banks. One reason why our products are generally speaking long only or very low leverage.
I see. So in that scenario where we do have another round of liquidation from these alternative investment vehicles, do you still feel or convinced that a strategy like DeepMacro, more quant-driven, more systematic, will be better for the new era?
Yeah, I do, because it's one thing is it is very systematic. We're not making judgment calls about how much risk we should have in equities versus fixed income, for example. That is we use machine learning in order to make those calls. Basically, the process is we give it a human-like question. what we really want to know is exactly the question that you asked. Is it a good environment for risk assets or a good environment for, say, fixed income? And then the machine will kind of classify where we are today versus all the points in time in the past that look similar to it or that look different, and therefore what kind of asset returns you can expect. And so I think that that is the right way to do it. If you allow emotion to take too much of a role, you're basically going to be selling lows and buying highs. And this one is kind of trying to use a very objective way of looking at the environment, making that determination, and then using that determination to make the allocation. And so far, so good.
So I remember when the first time you came to this interview, I asked you the question about where would you put your money, and you mentioned pound sterling.
Yes.
So now I'm going to ask you again with a very human-like manner.
Yeah.
Where would you put your money? It's still going to be long pound sterling. I mean, your own opinion.
Yeah.
And the DeepMacro model opinion.
Look, a clarification, the model is somewhat short-term in nature, and we'll have to go through the data to see how that turned out from the point that I made it. But once the Brexit, I assume that it's going to be determined, and look, I think the UK on its own has an extremely capable civil service and a competitive UK economy. With the sterling valued at these levels will be strong, and that eventually sterling will rise. That's my own personal view. The model and my personal view is that you probably should be in the dollar right now, overall. I just think that the risks that we're talking about in the US are probably going to be present in other countries, magnified by a factor. That's how it normally happens. I expect the same thing this time. So I think that from a currency side, you'd still want to be in the dollar. And on the risk asset side, again, we're fairly underweight equities right now, but not zero. I don't think that the situation is that bad. At a certain point, I'm sure that relative to the market consensus is going to get too bearish, and that's the point at which you probably want to start to add.
So long dollar, maybe neutral on euro?
Yeah, I'd say a little negative on euro.
Negative.
I'd say a little bit. I mean, if we're long dollar, we got to be short somebody. So I'd say euro definitely. Yeah, and then the smaller currencies as well on the commodity and the high beta ones, I'd be short them.
Well, then thank you very much for your time here, Jeff Young from DeepMacro. See you again.
Thanks, Thomas.
Thank you.